So the Great Recession, based on home values, total value of residential property in developed economies rose by more than $30 trillion from 2000 to 2005 to over $70 trillion, an increase equivalent to 200% of the developed nations' combined GDPs. That's crazy. Low interest rates helped spur that on, as well as people being encouraged to borrow money. And people have this belief that home prices can only go up. Households didn't like the stock market after the dot-com boom collapse, and so they put their money in homes. And then lending standards went down dramatically. Students asked me at the time, how can these home prices go up so much? And I said they couldn't. There's no reason for it. I was working on the assumption that when we went into a loan, the banks would actually check your credit history, check your income, do a pretty good check on your ability to pay that money back. It turns out they weren't doing that anymore. You walked into a bank and they'll throw $5 million, or not $5 million, maybe $500,000 at you. And these were known as subprime mortgages. These were ones that had high risk. Usually they would not get a mortgage, but during this time standards went down and they didn't care anymore. And a lot of banks actually encourage people to borrow the money, giving them teaser rates. Normally you would get like a 30-year fixed rate loan, which is the best deal to get still, but they'll give you teaser rates when you would pay maybe zero interest for the first maybe 2, 3, 4 years, and then rates will go up dramatically. Sometimes you paid less than you pay less than the interest amount that was due, and the principal went up. I mean, there were like 40-year loans. They were crazy. They're giving money out to anyone. And the idea was that if once the rates went up, you felt as a person speculating that you could turn around and sell your home at a profit before you had to pay the higher interest rates. People were not required to put any money down sometimes, which again is not good. You should have some stake into the home. Mortgage brokers reassure potential borrowers that given the rate price appreciation, they could have easily afford these things. The appraisers were overvaluing the homes. Everyone was in on this deal. And typically, in the old days, if you would lend money, you would hold on to that mortgage and you expect the person to pay it back. But what happened was that this time people were loaning money and they were dumping those mortgages as soon as they could to someone else. And so a whole new market was created known as collateral mortgage obligations, CMOs. What they would do is they would take pieces of mortgages, slice them up, and put them into this new type of package, which would have maybe 1% of that loan, 1% of that loan, maybe 1,000 loans. A portion of it would be in this security, and then they would sell them to financial investors out there, and they would hide the bad loans with inside these CMOs, and so all these subprime loans were hidden inside the CMOs, which are sold to unexpected financial investors. And as long as people made the payments on home loans, these things were okay. But the problem is once people stopped making their payments, when they realized that the home prices weren't going to go up anymore and they're actually going down, then these things started to lose their value. So housing prices peaked in about 06, 07. The subprime borrowers could no longer afford to make their payments, and the whole thing started to collapse. The recession officially started in December of 07. By March 2008, we started to realize it. At that time, we didn't see it coming. A lot of people didn't feel the pain yet. We started to see it in March when a big financial firm, Bear Stearns, failed. And this allowed, in terms of the government came in and they felt that maybe they should try to help it. And so they brokered a deal where they helped finance it, where JP Morgan Chase came in and bought it at $10 a share, when the 52-week high was $130. And that was a big loss for people who had their money in Bear Stearns. By September, it was clear we were in trouble. Government came in and they took over Fannie Mae and Freddie Mac, which are two government-sponsored agencies which provided funds for home loans. They would give home loans and they would they would finance a lot of these mortgages. And so they were hoarding a lot of these subprime mortgages they didn't realize. Lehman Brothers was a company that dealt in these CMOs, and once the whole market started to collapse, people pulled the money out of Lehman Brothers. They went under, and this time the government did not stop them from going bankrupt. AIG, the world's largest insurer, they got into this market insuring these CMOs. So remember, these are a bunch of mortgage in the CMOs, and all these mortgages were bad, and they sold insurance on these, which makes sense. If you buy a security and you want to buy insurance in case the security goes down in value or the company goes bankrupt and you lose all your money. And so they were financing insurance on these things, but we didn't realize at the time that they were selling insurance not just the hoarders of these CMOs, but to other people who are betting. So you buy insurance on, say, the CMO that you did not own, and you're betting that it would go down. And if it went down, AIG would pay you the value of that CMO. It's like buying fire insurance on your neighbor's house. If the house burns down, you get paid for the value of the house. Sounds kind of crazy, but they were selling these things right and left. And when the CMO started to go down, they couldn't cover all the insurance promises. And so the government came in and they had to bail them out as well. Washington Mutual Bank was a big bank, especially out here on the West Coast, and they had a lot of money in these mortgages. They were lending money out right and left, and they were trying to dump them as soon as they can, these mortgages. But when the whole thing started to collapse, they were hoarding a lot of these bad mortgages, and they went under, and JP Morgan had to bail them out as well, bought them out. And that's why you see Chase as a bank around Southern California. Those are all the old Washington Mutual banks. Then Congress had to come in and restart the bailout program. A big program was TARP, Troubled Asset Relief Program, $700 billion. It actually failed the first time in Congress. They had to come back and pass it about a week later, and that put a lot of money to bail out banks. Too big to fail became a term that Americans became accustomed to. Wells Fargo also came in, had to buy another big bank that failed. The auto industry was in terrible trouble because when people lose their jobs or they lose their home, they can't afford to buy a car, and so car prices plummeted. And so Ford, General Motors, and Chrysler, they went to Congress and asking for money from TARP. Citicorp also got in trouble, and they had, again, help from the government. And then we had money going into General Motors and Chrysler as loans. They actually paid the money back eventually, and the taxpayers made a little profit there on the interest. And then President Obama was sworn in office in January of that year, and a month later they passed this would be fiscal policy. They passed over $100 billion bill designed to pump money into the economy to increase aggregate expenditures. And a lot of money went out to states to hire back teachers, hire back police officers that were laid off because of the Great Recession. And then Congress passed what's known as the Dodd-Frank bill in 2010, and this brought in a lot of new regulations. It had the Federal Reserve now do stress tests on financial institutions to see if they're sound or not. So it brought in a lot of things that tried to prevent the Great Recession from happening again. And it also created the Consumer Financial Protection Bureau, which is a new agency designed to protect consumers' households against lenders, their practices. And as we talked about, the Federal Reserve, they came in and they bought what's known as toxic assets. And these are actually bad mortgages that a lot of banks had on their balance sheets. And they took them off their balance sheets so banks would hopefully survive. And as I mentioned earlier, these bad mortgages, they were bad initially, but once people defaulted and they were evicted, then the homes were still there, and it took a while to finally sell them. But the Federal Reserve actually made money on these mortgages. It took 5, 6, 7 years, but they did get the money back plus a little profit. Okay, and then we'll come back for lecture 2 on the time lags for fiscal and monetary policy.